This week on Wealth Track, a great investor bond manager who believes stocks could be the next big thing. Kathleen Gaffney of the award-winning Loomis Sayles Bond Fund explains why the 30-year bull market in bonds could be coming back to earth and why stocks could be launching into orbit. Next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. You've heard it proclaimed far and wide, and even by guests here on Wealth Track. The great bond bull market of our generation is over. But is it? And if it is, where do we go for predictable income? Well, it has indeed been a great bull market for bonds, and it has lasted more than a generation, 30 years from the early 1980s until today. During that period, interest rates on 10-year treasuries plummeted from a high of 15.84% in late 1981 to a record low level of around 2% recently. That's a stunning 14% drop. And as it works in bond land, when interest rates fall, the value of the underlying bond rises. So while bond investors are getting less yield income, they have been getting impressive capital gain appreciation from the bonds themselves. Over the last 3 decades, investors have received a 9.4% annualized total return from 10-year treasuries, not equal to but rivaling historical returns of stocks and absent their wrenching volatility and uncertainty. And despite mounting pronouncements declaring the death of treasuries by prominent money managers and pundits, in the last 12 months, 10-year treasuries have delivered a total return of 15% versus 8.5% for the S&P 500. Is it any wonder that investors remain wedded to bonds and afraid of stocks? But is this a case of rear-view mirror investing? Are individuals missing another generational market turn in the road ahead? In fact, is it already happening? Over the last 6 months, 10-year treasuries have lost more than a percentage point, while the S&P 500 has advanced nearly 26%. Today's great investor guest is a bond manager who, are you ready, believes a generational shift in the markets is occurring and it favors stocks. She is Kathleen Gaffney, longtime co-manager of the Loomis Sayles Bond Fund, among other fixed income funds and accounts, with bond legend Dan Fuss. Loomis Sayles is a Wealth Track sponsor, but Kathleen fits right in with our other great investors. She and the Loomis Sayles Bond team have been recognized with numerous awards for their outstanding long-term performance, including Morningstar's Fund Manager of the Year in 2009. I began the interview by asking Kathleen why a veteran bond manager such as herself believes stocks could now be the opportunity of a generation.
There are some important signals out there right now. The first one I look at is treasury yields. They're non-existent. And when I compare that to dividend yields, historically that's been a great entry point for stocks. And they're washed out in some respects. People have been heading for the hills, actually heading into bonds.
Right.
Exactly. That again is another sign that as the U.S. economy continues to grow and recover, there are great opportunities and the valuations are very attractive.
Let me ask you about the 30-year bull market in bonds, treasuries especially. And, you know, treasuries have been the major beneficiary of the fact that interest rates have been down from 15% in the 80s, you know, down to below 2% or around 2% today. So isn't it possible, given central bank policy, which has been very easy around the world, I mean, isn't it possible that the bull market in treasuries could continue for several more years?
It is possible. but going from 2 to 0 and then thinking about what's around the corner is a very unattractive opportunity. And we always like to think long term. So 2 to 0, maybe we do get there, but what I see going on is a lot more positive economic data, and that means with all the liquidity, we're eventually going to see rising interest rates. And I want to get prepared for it now.
So in preparing for it, is there a chance, and I know at the Loomis Sayles Bond Fund, for instance, that you do tend to sometimes be ahead of the pack, not necessarily to your benefit. So I mean, is it possible again with the Treasury calls that are out there and you've been out of Treasuries now for how long?
We have a couple of years.
A couple of years. So you've missed some pretty significant rallies in Treasury bonds.
We have. But we haven't chased them, we haven't gotten back in. That proved to be a very smart place to be in the first quarter of this year, which I think gives you some sense of what's going to happen when rates do start to rise.
So Kathleen, your colleague and co-manager Dan Fuss at a meeting the other day basically said that we are in the foothills of higher interest rates, and the foothills could last for quite a while. So what does one do in this transition before interest rates really do start going higher?
There are lots of things that investors can do. And I think foothills is a very accurate description because it's rolling up and down gradually. So within those pockets, there are opportunities to find some good investments. They're in equity or equity-like securities, and they're also in fixed income. Not treasuries, but in corporate bonds. We see some great value that's still there today.
So what have you done at the Loomis Sayles Bond Fund to basically to position yourself for this transition that you're anticipating? I mean, one of the things is that you've shortened the maturity, the duration of bonds, right?
We have. And a great way to do that was by reducing our exposure to investment grade credit. You've got some yield there, but when you think about the absolute level, when interest rates do start to rise, you're going to see potential negative returns there as well. They're becoming a lot more sensitive to how interest rates move as opposed to being more sensitive to an improving economy.
So this is an interesting point because investors have been flocking to bonds. They've gotten very risk averse after the financial crisis. Mm-hmm. And they've been flocking to, so everyone has been saying, go to the highest quality, i.e. treasuries, and also, the investment credit, the highest quality bonds. You have an interesting point, which is that instead of being risk averse, it's actually could be quite a risky place to be. And in fact, that if you're worried about loss of principal, that you actually are in danger of losing principal in investment grade bonds. Why?
It's simple math. We saw it in the first quarter. The 10-year was at 2%, and within just a short period of time, we went up 40 basis points to 240. Returns for the index over the first quarter were a small negative. And
so the returns for the index for the 10-year Treasury bond?
Yes, and
right.
using the government corporate index as a proxy. So we had negative returns there. And that's just a move of 40 basis points going from 2 to 240. As the economy gets stronger, we're going to see more violent moves. And I think investors are going to be unprepared for that.
But you mentioned that it could be gradual. So I mean, what's the risk that it's not going to be gradual? I mean, how concerned are you that these foothills could very quickly turn into very steep mountains?
It's the amount of time, so it's gradual over a couple of years. But again, in a short period of a couple of weeks, 40 basis points is a big move.
In the bond market, right.
In the bond market. If we go out 2 or 3 years from now, as interest rates start to rise, then the moves, I think, are going to be more significant. And it's going to be difficult to find the opportunities out there and get out of the way fast enough.
As I just mentioned, the investors are very risk averse right now, and they're looking for safety and liquidity. So if not treasuries, which has always been the place that we went for safety and liquidity, where do you go for safety and liquidity now in the bond market?
We're looking particularly at corporates, but in a slightly different way than we would have in the past. So when I think about corporates, I'm talking about investment grade and also high yield. And as you mentioned, in investment grade, some of that yield advantage has gone away. There's not as much of a cushion. So we want to make sure that when rates start to rise, we're not exposed to that. So where else in the investment grade arena do we see opportunity? And interestingly enough, it's away from US shores. It's in Europe, which might be a bit of a surprise.
That is a surprise.
But when you think about where can I get that cushion, that real yield advantage, there are investment grade quality companies in Europe, and I'm thinking peripheral Europe, right in the heart and center of what's going on right now, but in companies that we think are going to continue to do well. Yes, there is definitely a debt crisis going on, but corporations are going to continue. People will continue to turn the lights on, to use their phones. We may see a deep recession, but we're not worried about bankruptcies here.
So you're talking about, you say peripheral Europe, but Portugal, Spain, Italy.
Yes.
And I'm sure our viewers are going, you've got to be kidding.
Yeah.
And you're talking about what utilities and telecom companies in those countries. So this is not sovereign debt. These are corporates.
These are corporates.
And that's where you would describe them as being liquid and relatively safe?
Not as liquid as treasuries.
Right.
But if you're looking for good long-term returns, the yields there are pretty comparable to what we're seeing here for high yield credits. So in a stressful scenario, you might see some downgrades, but you're getting compensated for that risk. You're picking up a lot of yield. And what I like the best about them is that when those spreads, the yield on the corporate bond relative to risk-free treasuries, begins to narrow, that's most likely when the global economy is on track and the issues in Europe will have been resolved. That spread will start to narrow, and probably at a time when interest rates here are starting to rise. We're always looking for the type of bond that's going to move in the opposite direction, particularly when it's rising interest rates that we're talking about.
So that's very interesting. Before we leave treasuries, though, I want to talk about, so you know, at the Loomis Sayles Bond Fund, you've got, what, about 15% in, 5% in cash, and then another 10% or so in shorter-term liquid securities.
It's our Canadian government bonds that we do.
So that's what I was wondering. So are the Canadian government bonds, those are the substitutes that you would use now instead of U.S. Treasuries?
I like to think
for your
of them,
liquidity cushion.
Yes, I think that position, I like to think of it as doing double duty. It provides the liquidity if we need it, because we know there are risks that are out there today, and the market, I think, is going to remain volatile. So we always want to have that liquidity measure. But on top of it, we like Canada, the Canadian dollar in particular. There's some appreciation potential there coming from global growth. Canada's got a lot of natural resources, and we see that appreciation potential. So if a bond can do more than one thing for us, we really like it a lot.
Now, it's interesting that you mentioned the commodity play, because I know in the past when I've talked to you or Dan, that you have stressed some of the commodity producing countries and their currencies. You know, a lot of people are looking at China, which is a major source of demand for commodities. They're looking at a recession in Europe. They're looking at, yes, the U.S. economy is recovering, but it's recovering very slowly. It's still very modest growth. And they're saying the commodity play is over. You disagree?
In the long term, I disagree. There will be volatility in commodities, but if I hear everybody saying it's all over, there's probably a pocket of value there that we can hold on to for the long term. So that's one of the reasons we like Canada, but also Australia and New Zealand. Again, developed world good guys, they've gotten the fiscal discipline message. So their balance sheets, their country balance sheets are in better shape, and they're leveraged to that global growth.
China has just said it's going to allow more yuan-denominated issues, right, and overseas, and so is that going to be an opportunity as well?
What keeps us out of China is we always, as good analysts, want to make sure that we're getting information that we believe is reliable and we can understand it. And until we get that type of information, we'll avoid some of those markets.
So China then is an area that Loomis Sayles is avoiding because of those issues?
Yes.
Lack of transparency.
Yes, but we like the growth that we see there. So the way we play China is to look at some of the peripheral currencies or countries around China. So Indonesia, the Philippines, and Korea. Those would fit the bill that we think are good investments with good appreciation potential in the currency.
So as we go around the world, Kathleen, peripheral Europe, and high yield in the U.S., right?
Yes.
Pretty much. And then in Asia and Latin America, for instance. So take us, where are you seeing the best values as you kind of take us on a trip around the world in the Global Bond Fund?
Well, in terms of what I think is the best value today, right now, because I think the U.S. is in good shape and moving in the right direction, yet interest rates are lower. High yield looks very attractive, but with some caveats. So if you're in the high yield market, you want to know what you own. You want to focus on your issue selection. So I like high yield for that yield advantage in the near term and see those improving fundamentals, but I'm careful. That's got us looking at convertible bonds, which many of are rated below investment grade, so it's high yield, but a different flavor of high yield.
So let's talk about the convertible space, because convertible bonds, you buy them as bonds, but they are convertible into a certain number of shares at a given price within a given period of time. So what is it that's so attractive about convertible bonds to you at the Loomis Sayles Bond Fund?
They're hybrids, so that you're exactly right. They're a little bit equity at times and a little bit fixed income. We look for what are busted converts, so it would be a high yield substitute. The yield is going to be similar to a straight bond, meaning that equity option isn't worth much. You're looking at the credit. That allows us to get broader exposure in below investment grade in good companies without taking too much risk. There are other converts which are more equity sensitive. And I like those because, as I mentioned, the value proposition in equities is attractive, and we want to capture that upside potential. A lot of companies are sitting on cash. The balance sheets are in good shape, and now they're very focused on getting earnings going. We want to capture that, and the equity option is more valuable. So in some of the companies that we've owned straight bonds, Ford's a good example, we see more opportunity on the equity side, and they've got a convertible bond. That fits that profile. And also global companies that can gain market share in this very challenging environment. And that might be something like an Intel. So it's an Intel convert that fits that bill and gives us the potential to participate in that upside. And again, at a point in time that might be when interest rates are rising.
You said busted converts? Is that what they're called? What's a busted convert?
So that's where the stock has declined so much that the value of that option to convert into equity at some point down the road becomes absolutely worthless. So you do look at it just as a bond, and very frequently investors as a whole will shy away from the busted converts because it might be the only debt of the company that's outstanding. And for some people, it's not worth their while to take a look at it. We'll look for value no matter what shape or form it comes in if we think it's got good total return prospects.
One of the things that I was intrigued by is a new fund that you're participating in along with Dan at Loomis Sayles. It's called the Capital Income Fund, and it has a minimum exposure of 70% in stocks. That's a minimum exposure, and a maximum exposure of 30% in fixed income. What's the strategy there? And I'm wondering if I can use that as kind of a proxy for maybe the way you think my portfolio should look. With 70% equities minimum and a maximum of 30% fixed income.
It's an attractive vehicle because of that mix of equity and fixed with an orientation towards providing income, which all of us out there are struggling to find these days with interest rates so low. Interest rates are low because we're struggling to get that growth, but it is going to come. It's probably going to come with a cost of inflation, but those strong earnings and the valuations make equity look very attractive. Yet, it's not going to be easy to get through this transition, so we see a lot of volatility. Investors may see the value, but are very fearful of the volatility. The income, and particularly the yield from fixed income right now, provides some ballast to it. So you get that exposure, which you know is priced appropriately, but you get a little bit more extra income to help make it more defensive.
Here you are, a bond manager, and saying that the income opportunities on the equity side are really greater than they are in the fixed income side.
The total returns are more attractive on the equity side in the long term. The dividend paying portion of it on the equity side is attractive, and I think will continue to be attractive. It may be more volatile, and that's the important part of having those. We have higher yields from the high yield component. So many of the bonds that we're starting to populate that fund with are much higher yielding and give it some defensiveness.
As a risk proposition, where do you what do you think is more risky? Is it in the bond market or is it in the stock market? Do you think the stocks are less risky now than bonds are?
Well, from a valuation standpoint, if you're a long-term investor, I think you've got some great return prospects ahead with a certain degree of volatility.
In which asset class?
In equities.
In equities, in stocks.
In equities. So I think you've got very good return prospects there with a measure of volatility. On the fixed side, you've got some high current yield right now, but your total return prospects are narrowing.
So it strikes me that maybe Loomis Sayles is making a real shift in its view of which markets longer term now are going to be more attractive. Is that correct? I mean, the firm is basically saying, you know what, as an asset class, stocks, 70% stocks minimum in this new fund, that's where you should be for income and for total return.
It makes a lot of sense, and then focusing on that fixed income portion at 30%, it's the makeup of it, that it's primarily corporate securities or non-dollar securities. We are really getting away from market risk, that interest rate sensitivity, which I really think is an important message for investors out there. Interest rate risk is increasing, and it will continue to increase as the economy continues to strengthen. You want to protect yourself against those principal losses when interest rates do start to rise.
So the one investment for a long-term diversified portfolio, what should it be?
Well, thinking about value and thinking for the long term, I'm going to highlight the home builder sector, the large public home builders, and I think you could buy equities or bonds and be happy with the returns there.
Why the large publicly traded home builders, which actually, at least in the stock side, have done pretty well recently?
They have, but they also took a pretty big beating over the last couple of years. So to me, that's deep value. They have done well, and I think they will continue to do well as the U.S. economy continues to slowly recover. There are a lot of bets out there against it, and so I think you're going to see these companies do well as the U.S. shows the strength that it does have and gets back on its feet. Housing is going to be very important to the recovery of the U.S. economy.
And where in the kind of the credit structure would you, as far as a bond investor, would you look in the home builders? I mean, would it be in the senior credits? Would it be in convertibles?
Well, that's a great question, because most of the home builders right now are rated below investment grade. So they are high yield. It's names like Lennar, Kaufman and Broad. These are the public home builders. They're below investment grade. Some of them will come back to investment grade. And some of them have convertible bonds as well. So you get that hybrid, a little bit equity, a little bit fixed income.
If the bull market in bonds is essentially over, the great bull market, especially in treasuries, is over, and so many investors are invested in the bond market for two reasons. They want income and they want stability. So what role should bonds now have in our portfolios? How should we look at our bond positions and what they can do for us? Is it still going to be income, and is it still going to be stability?
There's definitely going to be income there. And in fact, as rates start rising, at some point treasuries are going to be attractive. So it's just it's the amount that you have in your fixed income allocation that treasuries will offer some opportunity, and you would want to add on to them as interest rates start rising. And that corporate securities with their higher yield advantage are going to provide that important level of income that everyone's looking for.
Kathleen Gaffney, so great to have you on Wealth Track. Thank you so much for joining us with the Loomis Sayles Bond Fund.
Thank you, Consuela.
At the conclusion of every Wealth Track, we try to leave you with one suggestion to help you build and protect your wealth over the long term. This week's action point is follow the lead of Kathleen Gaffney and the Loomis Sayles Bond Fund and consider convertible bonds. Convertible bonds are hybrid securities. They make regular interest payments, are senior to stocks, and less volatile. But their price also participates in the underlying stock price movement because they can be converted into a predetermined number of common shares. However, as Kathleen warns us, they are very complicated, so are best left to professionals. Morningstar recommends the 4-star Vanguard Convertible Securities Fund, which invests in both U.S. and international securities. Next week, we'll be focusing on small company stocks from around the world with a great investor who rarely appears on television. He is Whitney George, Co-Chief Investment Officer of Royce & Associates and Portfolio Manager of several of the highly regarded Royce funds. If you want to see our Wealth Track interviews ahead of the pack, subscribers can do so 48 hours in advance. To sign up, just go to our website, wealthtrack.com, where you can also watch past shows and find our one investment and action point recommendations. And that concludes this edition of Wealth Track. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sayles, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Research Affiliates, an efficient index for an inefficient market.